Good morning. Happy Monday, October 12th. Welcome to the Power Studio. I decorated for Halloween. We got a great show today. We got Ed Nwokedi from Red Swan CRE. He's going to talk about digitizing real estate assets. We got news with Brandy. We got robots taking over CRE. And we got highlights from the Rebuilding Minneapolis conference last week. It's going to be a great show. Power 30 starts now.
Some of the week's big headlines in commercial real estate. Let's start with this one. Buyers and sellers are growing further apart on pricing, pushing price discovery beyond what many anticipated. Chris Ludeman is CBRE's global president of capital markets. He predicts that uncertainty about how to underwrite net operating income will remain until the pandemic is under control. Cap rates have remained relatively stable and in fact have gone down for the best industrial and multifamily assets, according to Ludeman, and there's no shortage of equity capital. However, both foreign and domestic capital is targeting real estate and debt markets and is becoming increasingly accommodative, according to CBRE's report. Two of the largest African-American owned real estate companies in the U.S. are teaming up on a newly formed REIT that'll focus on affordable housing. Avanath Capital Management and McFarlane Partners jointly filed paperwork with the SEC to create that new REIT, which is reportedly the first to focus on opportunity zones, though it will look to other properties as well. According to an article by Globe Street, the company will invest in, develop, redevelop, and manage mostly affordable and workforce multifamily properties in opportunity zones. Paperwork filed with the SEC stated that, quote, "We believe we will be the first opportunity zone fund listed for trading on a national securities exchange." The partnership is set to acquire an initial portfolio of 9 multifamily properties across 6 states. Those U.S. jobs lost during the pandemic aren't coming back anytime soon. A Wall Street Journal survey indicates that 43% of economists don't expect those jobs to return until 2023. And that's consistent with what Dr. Mark Dotzor was saying in an RE Journal's interview last spring. He and our own Todd Phillips predicted another jobless recovery similar to the past 2 recessions. A stimulus package or 2 could fast-track the economy and shorten the cycle, but U.S. leaders can't seem to agree on the details of such stimulus. Robots keep popping up in commercial real estate circles, and I better watch out because they're probably coming for my job next. This video, courtesy of BBC News, shows a robot shop worker being controlled by a human in a remote location, although it looks like a well-integrated autonomous mechanical worker. Several miles away, a human is controlling its every movement remotely and watching via a virtual reality headset that provides a robot's eye view. This is the work of Japanese firm Telexistence, whose Model T robot is designed to allow people to do physical labor from remote locations, including their own home. In this case, the robot is working at a Family Mart shop in Tokyo. Plans are to do more than just drink bottles, though. Rice balls, bento boxes, and sandwiches should all be within its grasp. Landlords looking to add a robot helper need to think about increased demand for internet speed and connectivity, as well as increasing power needs. In another robot story, this time from Metro News, video shows a robot building brick and mortar houses in East Yorkshire, England. In place of human labor, the building is being constructed by a robotic bricklayer designed by experts at a British engineering firm. One part of the robot has a mechanism to spread mortar, while another, similar to a claw, picks up the bricks and lays them. The robot's controlled from a tablet that uses a sophisticated software control system to read digitized architectural plans. And heads up, we're focusing on robots' impact on industrial real estate in a future Power 30, so tune in. In an indication of unhealthy debt related to retail and hospitality properties, TREP's special servicing rate hit a 7-year high. The retail special servicing rate, that's the purple line on this chart, clocked in at 18.32% in September, up from 17.31% in August. The lodging special servicing rate came in at 26.04%, up from 24.99% in August, indicated by the orange line. Both the lodging and retail CMBS special servicing rates were the highest reported on record, and together they're dragging the average up as well. CMBS special servicing rates have consistently increased since March, climbing up to 10.48% in September from 2.83% in March. We expect to see office make it into this mix if work from home trends persist in the way that many employers like Target predict. Colliers released a report indicating the net lease sector remains a bright spot amid COVID's devastation of retail real estate. The report indicates that properties with investment grade rated tenants that are minimally impacted by COVID-19 will remain in favor with investors. Colliers expects to see continued competition among investors for high quality net lease properties, and that net leases will remain an active vehicle for 1031 exchanges. There's a great chart buried in this Colliers report showing the net change in GDP by major metropolitan market. It would appear geography is playing a key role in GDP contraction, with Las Vegas and Detroit contracting at twice the rate of San Jose, Washington, D.C., and San Francisco. Net lease investors swarming to tax-advantaged markets like Florida and Texas might be wise to consider other locations. RE Journals is hosting a live National Net Lease Summit on November 18th in Minneapolis, and yes, you can see people mask to mask at this event. POWER30 is hosting a Power Dinner the evening before the event. Tickets are available on rejournals.com. Todd, over to you.
Next up, highlights from Downtown Development Conference talking about rebuilding Minneapolis. Let's hear from Chris Carr and Bob Lux about downtown Minneapolis.
My name is Chris Carr. I'm really honored to be here with you. I currently work as the security director at Minneapolis City Center, and also serve as a co-chair of the Downtown Security Executive Group, and work with the Hennepin Avenue Safety Group and Safe Zone and other different initiatives. And I think when we talk about safety, in particular in downtown, the important thing for us to do is really look at what are those specific aspects of safety that people are experiencing a conflict with, and how do we address those? Because I really look at it a little bit more structured in terms of saying, what are the livability issues that are making people feel unsafe? Are there particular actions and behaviors that make that space feel uncomfortable? And then how do we assess that? We talk about things like, crime, part one crime, as we refer to it, a lot of the violent crime or assaults, robbery, rape, the really painful, serious felony level crime that exists, and how do we address that? And then we talk about the experience that we've had over the last several months with regard to civil unrest. And what does that mean in terms of our role in downtown? Because downtown is no stranger to demonstrations. This is something I've been in downtown for 18 years. We're pretty good at navigating people lifting up their First Amendment rights and marching and gathering in different points. It's when those behaviors are exploited by other people who might seek to do harm or do damage that are not necessarily operating on behalf of that greater message or cause that's being demonstrated. And so as we look at those three things, we really want to be intentional in what are the initiatives going on. As we talk about the livability challenges and things that people are experiencing, a lot of that does come from the perception and the reality of the not housed population. And how do we address that? And I couldn't agree more in terms of the need for more housing, and housing that is economically affordable. Through the pandemic, we have seen different increases from different populations of those who have been experiencing homelessness. And the lack of resources that people then are experiencing really has created these different types of livability challenges for both they and the population around them. The other thing that we think about within that is the lack of presence, and sometimes we talk about it as the broken window concept, in that some of the actions and behaviors when it comes to livability crime is really nothing new. What we are experiencing right now is there isn't a lot of activity going on around them, that are otherwise sometimes not experienced. And so when there is a withdrawal within a lot of different companies and entities, a lot of the corporate entities that we have thousands and thousands of people who are commuting into downtown that are understandably and making good safety decisions with regard to their populations, and people are working remotely, et cetera. But when you have a reduction of that level and just presence of people, what you encounter is this stuff that you may not otherwise see is a lot more visible. And so we have a lot of really great initiatives that are going on and have made over the course of time a lot of big investments in terms of relationships. The Downtown Improvement District and Safe Zone have really put forth incredible relationships between the public sector and private sector. And we work with a lot of different social outreach organizations. I sit on the committees that are working with organizations like Mad Dads, Youth Link, Youth Coordinating Board. We recently have had some of the individuals coming in that are the violence interrupters, and some of those folks who are able to build relationships with people who are just out hanging out or doing other things that is not particularly helpful to the environment, but being able to de-escalate or have people make different decisions that doesn't then require law enforcement.
So from my perspective, I've been working in downtown Minneapolis for better than 20 years, developing buildings, being very involved with a number of the downtown council and Meet Minneapolis, and watching our city grow every year when Steve would announce that there's another 10,000 people that are living in downtown, and the number of jobs that have been created over the last 15 to 20 years in downtown. And it's my true opinion that downtown's future is bright. And I think that it just is important for us all just to take a deep breath and to understand that these challenges, we will get through them, and people still want to live downtown. I was speaking to the manager of Latitude 45, which is a project that we did a few years ago over on Washington Avenue, 320 units. Their occupancy today is 93%. They leased 19 units last month. So for those of you that are in the audience today and they're saying everybody's exiting downtown, I would encourage you to ask the folks that are on the front lines, which are the managers of some of the apartment complexes or condos. I do think that we're at an inflection point where our civic leaders, the mayor, I know really well, the city council, they're well-intended folks, and there's nobody that is speaking where they're not trying to solve a problem. And we're being faced with issues right now that none of us are familiar with how to deal with. And I guess, and Steve was referring to some of the stuff I'm really passionate about. One of the things that I think we need to do is to figure out how to collectively get our corporate citizens and our mayor to work together and to respect each other and to acknowledge that we've got social issues in our community, housing being one. For affordable housing, we just need a larger supply of housing, and we've got to deal with all of these issues. We can't police our way out. We've got to get people back to work at some point. That's not today, that's probably not next month, but I do think it would be important for the collective corporate citizens and our leadership within the city council and the mayor's office to pick a date, and then let's try to get a portion of the workforce back. We moved into the IDS in June, and that was a hard decision for our companies to continue to hold a stake in downtown. But I really do believe that the future of downtown is bright, and a lot of which is because of folks like this. But I think we've got to stop pointing fingers at each other, and that the blame is. Well, and Minneapolis has celebrated our arts community for years because it's one of the best in the country, if not one of the best in the world. And it's going to take time. And as Jonathan mentioned, our cities and our counties, they can't print money. The federal government is the only one that can actually print money, and we have to have leadership at that point that helps the arts community and the housing community. And I would just say again, I think it really is important for the 100 people that are in the audience today, plus the multiple hundreds that are probably online, this is not something that any of us have ever dealt with before. And I think we just have to be gentle on folks. But I think right now in Minneapolis in particular, I think that the corporate leadership that from Jonathan and Steve and Charlie Weaver's group at the Minnesota Partnership, I think we've got to encourage our corporate leaders who really are experienced at dealing with, thousands of employees, of how they can help our city and our city leaders actually get us back onto the playing field. We have 100 people here today. They're all socially distanced. They're wearing their masks. They're doing stuff correctly. We can do that in a work environment too. And I think that I'm back to the point that we've got to pick some days, because if we just have this trickle back over a longer period of time, to Chris's point, the safety is not going to be there. We need people, and we need them to be safe, but we need people. And then, all of the supportive activities, the majority of the folks, I've lived downtown for years and I've been in the community for years. The majority of the problem is of the folks that you witness on Nicollet Mall are mental illness issues and addiction issues. And then now we're getting some of the folks that are just coming into town because they don't have anything else to do. They're just hanger-oners. And we have to help those folks have places to live. And that gets back to the affordability of housing. We need more supply. And Dean DeVolis is in the audience today. And Dean is going to be talking later, I'm sure, about we have to solve the affordable housing issue through technology and through innovation. We cannot rely on the city government to provide, more and more TIF for stuff. And it can't be, we've got to be able to innovate our way out for housing. And so I'm a big believer that the responsibility in my mind is clearly on the corporate leaders who are experienced with dealing with, thousands of employees, to help Jacob Fry and the city council, to help them lead us out of this. People want to live in downtown Minneapolis. And the reason that we've gone through 10 to 20 years worth of growth is because people love the mosaic of humanity that downtown brings. We don't want, people that want a sterile environment, they'll live in Hugo or Oswego or somewhere else. And that's fine, not being critical of that group, but people that want to really enjoy the mosaic of life, Minneapolis really does provide that. Minneapolis has a bright future. We've got to work together. Again, not to overemphasize, but I really do put a lot of the pressure on the corporate leaders to get with our politicians and work together on it, and then work together with the police force, because we've got to stop pointing fingers and we've got to make stuff happen. So I'm really bullish on Minneapolis long term.
Let's go over to Ed and Nwokedi. Ed, tell me about Red Swan CRE.
We are a fintech platform focusing on commercial real estate and democratizing real estate to make sure investments are more affordable and more accessible for investors, as well as providing liquidity for building owners.
Just give me a 30,000 foot overview, and I know that's even hard to do, but walk through the pieces of what's important here. What are you creating and how does it work?
We're creating a new asset class called digital securities. The SEC in 2018 passed regulations that security token offerings are now legal. You probably remember the ICO craze, which was when tokenization came into effect along with blockchain, and people were just creating tokens and putting a name on them and then hyping tokens up and trading them. And it was really based on nothing. But I started to look at more and more how that technology can benefit real estate. And I realized that two things. One, by democratizing and digitizing an asset, you can make it more affordable, right? So now the price for entry is no longer $2 million or $500,000. It's more like $5,000 to $40,000. So that makes it much more affordable for the average person to get involved. And then two, I saw it as a way to create more capital, because there's capital stacks on every property, and usually it goes like this. You have the GP that has a percentage, the LP investors he brings on, they have a percentage, and then the debt, the bank has a percentage, and that's usually the full capital stack.
If I have now a token, what do I own? Could I make it akin to a stock share? Would that be a way of thinking of it, or is it fundamentally different from that?
You're actually right. You can look at a token as being a share of stock, and you can look at tokenization as being IPOing a particular property. And you can tokenize even, a company that has shares for shareholders. You can actually tokenize all the shares so they now become digital, which is actually happening on the NASDAQ. But yes, it becomes a share of stock. And just like in a regular company, there are different levels of shares. I mean, there's Class C, there may be Class B, and they may have different rights, voting rights, no voting rights, dividend distribution rights, things like that. So you can look at this as just a class of stock that's being issued against a property. And it's always issued, in our case, against the net equity. So, you look at a $100 million property, you subtract the $50 million worth of debt, and then the equity is really $50 million, and that's what we're now issuing shares on to divide that equity up.
That makes sense. So now if I think about, am I just buying, is the token good for one piece of real estate, or does this work at a portfolio level like a REIT, or are you kind of making it one at a time?
We're making it one at a time, but because we think every property has its own identity. But there are clients who are coming to us who have a portfolio of multifamily or residential type assets, and they want to pull them together and call it, their ABC portfolio token, right? And so they're now bringing all three assets into one, and they tokenize the equity for all of them, which is fine. You can do that. We try to make it individualistic because we want to allow investors to buy what they want to buy as opposed to buy what they have to buy. Because democratization allows them to say, hey, I only want Class A multifamily assets in CBD of most major cities, right? If you're buying farms someplace, I'm not interested in that. But a lot of times the REITs, you kind of have to take the good and the bad. And so we're trying to really make it easy so investors can pick and choose what they really want.
Well, and knowing real estate investors like you and I do, they all have a different idea of what's good and what's bad. Does this have a liquidity feature that can be different from owning the property outright?
Yes, it does, Todd. It has a liquidity feature in that typically in real estate, there's rights that the sponsors have in that you have to stay in the investment for the full cycle. And the only way you can get out of the investment is if they give you permission or they buy you out your shares. You really don't have a market where you can advertise your partnership ownership into some kind of marketplace and sell it. And you have to usually get permission from the principals. In this case, with digital securities, you don't have to have the permission. It's already intuitive that you own these shares. And if you ever want to liquidate these shares, whether times are good and you're making a profit, or as you see times are bad and you want to get out ahead, you can. And so that makes it very interesting for us because, of course, in order to have the best liquidity, you have to have a pretty broad marketplace of buyers who will buy something at a certain price. And really that means we need more people involved in ownership to create more of a market appetite for buyers. And I think that we're bringing a few $1 billion worth of properties to the market, but I think once you have several $100 billion worth of properties in the market that are owned by individuals, you're now going to have that liquidity because any given day people have a need to sell. Either they're fearful that the election is going to go the wrong way and they want to sell now because they think the world's coming to an end, or they have a wedding and they have to cover the cost of the wedding, and this is the only way they can do it is by liquidating shares. So there's always a need for liquidity, and by having digital securities, you no longer have to ask the sponsor for permission to sell. You can just send your shares to either Red Swan and we can post them up into our network marketplace, or you can register to another exchange, digital exchange, and allow them to put it to their market and exit. And it's all going to depend on price and demand, right? I see it taking off. That's why I'm excited about it. But I think it is taking off based on all of the things that I'm seeing in the marketplace and all the people we're talking to, and what we see a lot of the larger corporations doing. is definitely taking off. Everything is kind of moving towards digitization just because it's easier and more transparent, and it's safer, and it's faster to transact. So a lot of things are moving towards the digital age. And I really think that for real estate, this will become the future for real estate investors because, for one, you mentioned the Class A and the Class B, and some people love the Class B or C because they look at it as, ground floor, something that they can get their hands on. They understand the tenants on the Class C level, and they think that they can also add more value. They can clean up and paint the place and put on new carpet and then raise the rents. And a lot of your smaller investors, private investors, are geared towards Class B and Class C assets. Then you have the institutional Class A assets, which are the ones you see on Main and Main, which are shining, perfect, well managed, and the rents are extremely high. It doesn't need any fixing up. It's already setting a standard. Well, it's unfair to me that many of the smaller, or I'd say more private investors, don't get an opportunity to invest in those high-end Class A properties because the big institutions that have so many billions of dollars buy it first. I mean, they compete against each other and buy it, so they really control, I would say, 70% of all that high-end Class A product.
Yeah, for sure.
And so the small investors don't even get a chance to participate. And so I think by using digitization, small investors can have a little bit of both, right? You can take a risk on the property down the street that's Class C that you can fix up, or you can watch the manager fix it up and give some suggestions. But you can also follow Warren Buffett on his real estate investments he's making in Manhattan or in Los Angeles. And if he's getting an 8% return, you're comfortable because you're now learning from his expertise, right? So I think it makes everyone better when they can kind of share into the same investment.
What is a token considered? Is it considered a security? And then there's got to be a digital market, right? You keep talking about digitization. How does that differ from the NASDAQ or Pink Sheets or something like that?
It is considered a security, and so it's a security asset that's backed by some hard property or hard asset. And so, yeah, it is regulated just like the SEC regulates regular stocks and bonds. You have to register the assets. You have to make sure that they're being traded with a certified personnel that has a license with FINRA. And you have reporting on a regular basis with represent investors who want to buy our investments that we have registered, right? So they want to come into one of our sleeves, which are different properties. We can explain the investment to them and put them into that property, and that is within our license purview. But if we also can take those same shares and allocate them to a broker dealer and say, hey, you can sell these to your clients, and then they'll turn around and sell to clients, and then come back to us for a fee for.
Is there a digital trading platform?
That's really where all the activity and the money is down the road, is when you have, you create this, like, let's call it a mini NASDAQ, right? Yeah. With a market cap of $1 trillion worth of shares of maybe there's 200 different properties in that market cap. And people now want to trade, and you have hedge funds coming in because they're looking at being a market maker. Person wants to trade, and they want to sell it for $2, and they think that they can turn around and sell it to the buyer who will pay $250 or $270. They'll make that trade all day long. So yeah, that's when it gets interesting, is when you have quite a bit of projects or securities in your market cap, and now people come in the secondary market so they can make fees or be a market maker and make the spread between the bid and ask.
I love this industry. I love the idea that you can buy little chunks of things and trade them eventually down the road and be able to be a small part of a bigger thing and be able to make smart decisions. Is there anything we didn't talk about?
Let me tell you something that is new that we're doing, because I'm looking for all different types of distribution channels so we can be successful right out of the gate. And I started to focus on the crypto industry, cryptocurrency industry, because there's about $380 billion worth of cryptocurrency out there, and they don't sleep well at night because cryptocurrency is very volatile, right? And so their prayer is that it's going to keep going up and up, and I think they're right. I think crypto will continue to go up because it's a channel that the globe sees as being something that's stable. It cannot be, I should say, influenced by government or by institutions. So people who own the crypto don't want to sell it. They want to keep owning it and keep it going up. But you have many of them who are crypto rich and cash poor, because it's not paying off any dividends, right? It's not giving any kind of yield. It's just kind of like, let's see if it goes up this month. Hopefully it goes up a little bit this month. Oh, if it goes down, oh, wow, I just lost a lot of money. Well, we're using real estate to be a hedge against the crypto fluctuations by basically, there are lenders out there now who love crypto as well, who will lend on crypto up to between 50 or 80% will loan on the value of crypto. And we're influencing those lenders to let them take those proceeds and buy into commercial real estate, right? So if they can loan on crypto at 4%, for example, and they can borrow, 80% of that money, and it's called $1 million, they can buy $800,000. They can now buy a piece of real estate that we're selling that's issuing a preferred return annually of, let's call it 6.5%, 7%. So right away, they're already cash flow positive in terms of the delta from what they borrowed to what they're receiving. And there's no collar to control, to limit the growth of the crypto. It still can keep going up, right? And the same token, the real estate, digital securities on real estate can also improve in value, because usually real estate will improve in value as they improve the rents. So now you have double down and have two assets that are growing, and it's protecting you, because if you borrowed 80% and put it in real estate, at least the assets we're selling will probably not go down in value anytime soon. So, if the crypto falls down 50% in value, 80% of your money is still now secured under real estate. Your lenders are going to like that a lot, and you're going to like it a lot too, because you have a double basket of revenue potential. So we're doing that as a way to kind of encourage those who are crypto holders to get more performance out of their crypto.
So what is the minimum buy on your PPM?
Right now, the smallest buy is a $5,000 investment that's actually on a B+ asset in a very nice neighborhood, one of the highest school districts in Houston, and it has a pretty attractive yield to it, along with a HUD loan, so it's fixed for 40 years, so that you don't have to worry about refinancing the loan. So that's an attractive asset, and it's a low cost of entry because it's a lower price point. So we think that providing this is really doing a favor, a big advantage to the investors in the world, the real estate world, as well as to property owners. When you look at it from a property owner standpoint, there's at least 35% equity trapped in every commercial real estate project, right? You take a $50 million project, the bank is giving a $25 million loan. The highest they're going to go maybe the 75% loan to value. Maybe if it's HUD, it can be 80% loan to value. But there's always that residual there, which is equity cushion that the bank feels really comfortable with, because if anything goes wrong, that's your money that's going away, not theirs, right? And so now we allow an opportunity for these property owners to pull out a big chunk of that capital and use it for further development of their business, or repay themselves or their investment they've made, by allowing other investors to come in on that equity capital stack. We're trying to really simplify that process to make it much easier for investors, and even to get out much easier. So they don't have to say, oh, please, when are you going to sell the property? And the sponsor says, well, as soon as the market gets better, we'll put it on the market, we'll sell it. That's going to be another 6-month process. Go through brokers, put it on the market, and see what the offers come back.